The financial system just crossed a line that will not be uncrossed. For the first time in decades, gold has overtaken United States Treasury securities as the largest foreign reserve asset held by central banks worldwide. The tipping point happened quietly between late 2025 and the opening weeks of 2026. And the reason is worse than you think. While markets focused on rate cuts and inflation headlines, the architecture beneath the dollar was being rewritten in real time. Central banks across the world did not pause their gold purchases when prices hit record highs. They accelerated. Gold reserves held by foreign central banks now exceed $4 trillion in value. At the same time, their holdings of United States debt instruments have declined in both absolute terms and as a percentage of total reserves. This is not portfolio rebalancing. This is a structural change in how sovereign wealth is being stored. Here is what just happened. Between 2022 and the end of 2025, global central banks purchased over 3,000 tons of gold. In 2026 alone, projections from investment banks place central bank gold demand at 800 tons. That figure represents roughly 26% of annual global mine output. To put this in perspective, 800 tons of gold at current prices translates to over $50 billion of direct sovereign purchasing power flowing into a single asset class within 12 months. These purchases are not driven by profit motives or speculative positioning. They are reserve diversification moves made by institutions that control national monetary policy. China holds 2,298 tons of gold in official reserves. Russia holds 2,336 tons. India holds 880 tons. The BRICS bloc collectively controls over 6,000 tons and accounts for more than half of global central bank gold purchases since 2022. Now here is what that triggers. When central banks buy gold at this scale, they are not just acquiring an asset. They are signaling a vote of no confidence in the existing reserve system. Gold does not pay interest. It cannot be printed. It cannot be sanctioned through financial networks. And it does not rely on the creditworthiness of any single government. These characteristics make it the ultimate sovereignty hedge in an era where currency weaponization has become policy, which is exactly where this goes next. But that is not the part that matters. The mechanism driving this shift is more revealing than the shift itself. Gold is now valued higher in central bank reserve portfolios than United States Treasury bonds. This crossover happened because of two simultaneous forces. First, gold prices surged from under $2,000 per ounce in 2022 to over $5,500 per ounce by late January 2026. That is a 140% gain in less than 4 years. Second, foreign central bank holdings of United States Treasuries declined from a peak of over $7 trillion to approximately $6 trillion as of mid-2025. The combination of rising gold valuations and falling Treasury allocations created the inversion point. Here is the first part. When a central bank sells Treasury securities and buys gold, it is executing a de facto downgrade of dollar-denominated debt as a store of value. Now here's what that triggers. Every ton of gold purchased with dollar reserves removes liquidity from the Treasury market and shifts it into a non-yielding hard asset. This reduces demand for new United States debt issuance at a time when fiscal deficits remain elevated. It also signals to private investors that sovereign institutions are treating gold as a superior long-term store of wealth, and with a forward hook, which is exactly where this goes next. Here's what they assumed you would not notice. The buying has continued even as gold reached all-time highs above $5,000 per ounce. Traditional economic theory suggests that high prices reduce demand, but central banks are not price-sensitive buyers. They are strategic accumulators. Surveys conducted by the World Gold Council in late 2025 found that 95% of central bank respondents expected global official gold reserves to increase over the next 12 months. That is the highest level of consensus ever recorded. 43% of central banks indicated plans to increase their own holdings. None anticipated a reduction. Now watch what happens when this hits the system. The shift in reserve composition is creating feedback loops that accelerate gold demand. As more central banks add gold, the perceived safety and legitimacy of gold as a reserve asset increases. This makes it easier for other central banks to justify similar moves to their governments and populations. The result is a self-reinforcing cycle where diversification by one institution validates diversification by others. Investment banks have taken notice. JP Morgan raised its year-end 2026 gold price forecast to $6,300 per ounce. Goldman Sachs forecast $5,400 per ounce by December 2026. Both projections cite ongoing central bank demand as the primary driver. But here is what they assumed you would not notice. The timing of this shift coincides with geopolitical fractures that have made the dollar reserve system less stable. Sanctions imposed on Russia following the conflict in Ukraine demonstrated that dollar-denominated assets can be frozen or seized through coordinated Western action. This created a perception problem for non-aligned nations. If reserves held in dollars or dollar instruments can be neutralized by foreign governments during disputes, then those reserves are not truly sovereign. Gold held in domestic vaults cannot be frozen by external actors. It exists outside the reach of swift payment networks and correspondent banking relationships. For nations concerned about financial sovereignty, gold offers insurance that paper claims do not, which is exactly where this goes next. But that is not the part that matters. The BRICS bloc has moved beyond accumulation into infrastructure building. In late 2025, BRICS nations unveiled a prototype digital trade currency known as the unit. The unit is designed as a gold-anchored settlement mechanism for cross-border transactions between member states. It is structured as 40% physical gold backing and 60% national currencies of BRICS members. This is not a replacement for domestic currencies. It is a parallel settlement layer designed to bypass the dollar in intra-BRICS trade. Here is the first part. If BRICS nations can settle trade in a gold-backed unit rather than converting through dollars, they reduce their need to hold dollar reserves. Now here is what that triggers. Lower structural demand for dollars and dollar-denominated debt from the world's largest emerging economies. This creates pricing pressure on United States treasuries and downward pressure on the dollar exchange rate over time, and with a forward hook, which is exactly where this goes next. Now watch what happens when this hits the system. The shift is not limited to BRICS. Poland increased its gold reserves by over 100 tons in 2024. Turkey added over 250 tons since 2022. Even smaller nations like Serbia and the Philippines have announced plans to increase gold holdings. The pattern is clear. Central banks are moving in the same direction regardless of political alignment or economic structure. Here's what they assumed you would not notice. The Federal Reserve has been publicly dismissive of the gold rally. In late January 2026, Federal Reserve Chair Jerome Powell was asked directly whether the surge in gold and silver prices indicated a loss of confidence in the dollar. Powell downplayed the signal. He suggested that gold prices reflect a variety of factors and do not necessarily indicate concerns about dollar stability, but markets are not buying that narrative. Gold hit $5,595 per ounce on January 29, 2026. Silver surged past $88 per ounce the same week. These are not speculative bubbles driven by retail momentum. These are institutional flows reflecting a fundamental reassessment of reserve risk. Now watch what happens when this hits the system. If central banks continue purchasing gold at the current pace, the price trajectory becomes exponential rather than linear. Supply from mining is relatively inelastic. Global mine production adds roughly 3,000 tons per year. Recycled gold adds another 1,200 tons. Total annual supply is around 4,200 tons. Central bank demand alone is projected at 800 tons for 2026. Investment demand from exchange-traded funds and private buyers is running at record levels. Jewelry demand in India and China remains structurally strong. When demand components add up to more than available supply, prices must rise to ration the available stock, which is exactly where this goes next. But here is what they assumed you would not notice. The price of gold is not just a commodity signal, it is a real-time vote on the stability of fiat monetary systems. When gold rises despite central bank tightening and higher real interest rates, it indicates that investors are pricing in tail risks that policymakers claim do not exist. Those tail risks include uncontrolled inflation, currency debasement through continued deficit spending, loss of reserve currency status, and financial system instability triggered by cascading sovereign debt crises. Gold is the hedge against all of these outcomes. Now watch what happens when this hits the system. If you are a saver, the shift means that holding cash or cash equivalents is a losing position over time. Currencies are being debased through persistent fiscal deficits and monetary accommodation. Gold is outperforming cash by double-digit percentages year over year. That trend is structural, not cyclical. If you are an investor, the shift means that traditional portfolio allocation models are outdated. A 60-40 stock bond portfolio assumes that bonds provide safety and diversification. But when central banks are moving away from sovereign debt as a reserve asset, the safety assumption breaks down. Gold is now filling the role that treasuries used to play. If you are just trying to live normally, the shift means that the cost of goods and services will continue rising faster than official inflation statistics suggest. Precious metals are signaling that currency debasement is accelerating. That debasement shows up as higher prices for food, energy, housing, and healthcare. Your purchasing power is being eroded in real time. Now here are 5 actions phrased as positioning and awareness. Watch central bank reserve composition reports published quarterly by the International Monetary Fund. When gold allocations continue rising and treasury holdings continue falling, the trend is confirmed. Avoid chasing short-term price moves in gold and silver. Volatility will increase as speculative flows layer on top of structural demand. Position for the structural trend rather than trading the noise. Prepare for a multi-year repricing of hard assets relative to financial assets. Gold, silver, real estate, and commodities will outperform paper claims over the next decade. Track credit spreads and sovereign bond yields in peripheral economies. When spreads widen and yields spike, it signals stress in the debt system. Gold rallies during those episodes. Do not chase late-stage equity rallies funded by central bank liquidity. When the liquidity cycle turns, financial assets reprice violently. Hard assets provide downside protection. Now here is what comes next. The next shoe is already in motion. Central banks are not going to reverse course. The incentives that drove them to buy gold at $3,000 per ounce are even stronger at $5,000 per ounce. Higher prices validate the strategic logic of accumulation. They also create urgency for institutions that have not yet diversified. The longer a central bank waits, the more expensive gold becomes and the less favorable their entry point. This dynamic creates front-running behavior. Central banks that were on the fence are now moving to lock in positions before prices move even higher. The feedback loop is accelerating. Investment banks are projecting $6,000 per ounce by year-end 2026. Some independent analysts are forecasting $8,000 per ounce by the end of the decade. These are not fringe predictions. They are based on structural supply and demand imbalances that cannot be resolved at current price levels. Here is the unanswered question. What happens when the general public realizes that central banks have been systematically moving out of paper assets and into gold for 4 straight years? When that realization spreads beyond institutional investors and into retail consciousness, demand will spike. Gold and silver will become not just portfolio hedges but cultural symbols of distrust in the monetary system. At that point, the repricing accelerates beyond the control of policymakers. The financial system just crossed a line that will not be uncrossed.